Welcome back. To many people's surprise, including my own, pending home sales actually increased by 1.1% in September compared to August. That was a significant beat of expectations because the forecast called for a 1.8% decrease, not an increase. However, despite this 1% rise in September, pending home sales measured by the National Association of Realtors is now at the third lowest reading on record for data that goes all the way back until January of 2001. On top of that, they're also lower than any other month from 2001 through 2019, which means that the level of contracts being signed between buyers and sellers of existing houses is now lower than the Great Recession. To say I have a lot to share in today's video is an understatement. And on top of that, a new report just announced today, which is November 1st, stated that more people are moving to adjustable rate mortgages amid this housing affordability crisis we have in the United States right now. So of course, I have a lot to share in today's video, but if you guys haven't subscribed to this channel just yet, I invite you to do so because I post frequent housing market updates so you guys can be more informed. Thank you so much for doing that, and let's begin today's video. So here's the actual press release from the National Association of Realtors, or NAR. Pending home sales increased by 1.1% in September here. However, compared to 1 year ago, it's down by double digits, and I'll share that with you guys here in a little bit. What's wild about this rise of 1% in September, this really caught a lot of people by surprise because, again, the forecast actually called for a decrease, not an increase. And on top of that, rates increase in September compared to August. So here's Freddie Mac looking at monthly rates. This is on our good Uncle Fred's website here. The source is Freddie Mac. And by the way, if you guys ever see this snapshot regarding rates, according to Freddie Mac, if you guys want to see monthly rates, weekly rates, quarterly or annual rates, you just go to edit your graph right here. Anyway, just a side note here. When looking at monthly rates, though, again, for September, or I should say for August, we're at 7.07% according to Freddie Mac. That's the average 30-year fix for people with great credit. But it increased to 7.2% in September. So despite this relatively small increase in rates, pending home sales actually increased this September. The National Association of Realtors also provided the levels of contracts being signed right now for each of the four major regions because they varied quite a bit here. It says Northeast, the Midwest, and the South posted monthly gains in transactions, while the West experienced a loss. All four U.S. regions had year-over-year decreases in transactions. So here is a snapshot looking at that. Right now, look at this. So we have the Northeast, the Midwest, the South, and the West here. So every single region experienced a gain compared to August, except for the West, which the West decreased by 1.8%. In the West as well, compared to 1 year ago, they also experienced the biggest decline as well, down by 12.9% versus 10.7% in the South and down by 12.7% in the Northeast. I should mention all these figures here is based on what they do call the Pending Home Sale Index, or their PHSI. This is a measure of contracts being signed between buyers and sellers of existing houses. Obviously, the higher the index is, it means there's more contracts being signed. And obviously, the lower the number, it means we're seeing a decrease of contracts being signed. And the reason why I really like to kind of provide my own analysis of their data here is that this is very much a forward-looking indicator of closed home sales, because contracts being signed in September is really going to be a measure of closed home sales in the next 1 to 2 months. So in October and November to be exact. So before I share my own analysis here, here's what the National Association of Realtors Chief Economist Lawrence Yum had to say here. Despite the slight gain, pending contracts remained at historically low levels due to the highest mortgage rates in about 20 years. Furthermore, inventory of existing houses remains tight, which hinders sales but keeps home prices elevated. I actually agree with him regarding this. So here's my own analysis of their data here. So their index for September which is at 72.6, far below 2020 through 2022, by the way. But at 72.6, that's a decrease of 11% compared to 1 year ago, but a small gain of 1.1%. Now, here's something I found to be interesting, though, is that the previous month, which of course was August, the reading was only at 71.8. The reason why I mentioned that is that excluding April 2020, and that's obviously when we had COVID lockdowns, that was an all-time record low by a long shot for data that goes back to January of 2001. The prior low was set back in November last year, when back then the reading was at 75.5, and it decreased to 71.8, a huge decrease from the previous all-time record low. If we were to exclude April 2020, where during that time, obviously, a lot of people couldn't even leave their houses, let alone look at houses and place offers on properties. So it says a lot here that we are only up by 1.1% compared to the all-time record lows that was set last month, excluding April 2020. Additionally, as I mentioned at the very beginning of this video here, when looking at pre-COVID levels, the level right now at 72.6 is at the lowest levels from 2001 through 2019, which means the level of contracts being signed, at least for September, is lower than the Great Recession. Now, having said that, contracts being signed, or the PHSI, has now increased in 6 out of the last 10 months. So let me break this down for you guys, because this is pretty, I just can't believe that contracts actually increase. But I will say that, keep in mind, in August, we're at all-time record lows by a long shot, excluding the onset of COVID here. So we only had really one direction to go, and that was basically up, right? Any case, when looking at the year-over-year changes, again, down by 11% compared to September of 2022, this marks the 28th consecutive month of year-over-year decreases. The last time we had an increase year-over-year was back in May of 2021. Also, September's index is far lower than the average going back to 2010 as well. So based on my nerdy analysis right here, which is right there, the average September year-over-year change going back to 2010 was a decrease of 1.1%, whereas this month we saw a decline of 11%. So far worse than historical averages. Now, when looking at month-over-month changes, though, entirely different story here, because it increased by 1.1% compared to August. The historical average, this is the historical average from August through September each and every year, going back to 2010, is a decrease of 1.1%. Whereas this month, we saw a gain of 1.1%. Additionally, here's something I noted here as well. Of course, this was a surprise increase because the forecast was a 1.8% decrease, not an increase. On top of that, this is actually the biggest month-to-month change since January this year. Back in January this year, we saw a huge gain of 8.1%, whereas this month, a gain of 1.1%. But still the biggest increase since January this year. Also, here's something that's a big reversal compared to what I reported about a month ago, because for comparison's sake, the index of the contracts being signed fell by 7.6% from August through September of 2022. In other words, the market was falling much faster last September compared to this September. Now, here's what I mean by that. A gain of 1.1% this September. 1 year ago, we saw a decrease of 7.6%. So the market right now is not falling at the same rate we saw last year. And in fact, we actually saw an increase, a small gain of 1%. Now, this is quite a turnaround compared to what I reported to you guys a month ago, because last month, we saw a huge decrease of 7.1% compared to July. Compare that to August of 2022, it was only a decrease of 2.1%. So when I reported to you guys 1 month ago, I said that the market is falling much faster this year compared to the same time frame last year. Now that has been completely reversed here, because in September, Last year, down by 7.6%, whereas this year, we're actually up by 1.1%. I would say the housing market is quite volatile, to say the least, and the data is ever changing every week and, of course, every month as well. Here's something we also know as well, because I actually want to look at what is the change compared to pre-COVID levels. So the change in contracts being signed from this September compared to September of 2019 is a decrease of 31%. Compared to 2018, we're down by 30%. So the levels of people signing purchase contracts right now is well below pre-pandemic levels. So I also want to mention this because we have quite the tale of two entirely different housing markets. This is the resale market, looking at existing houses, which is the stats I'm sharing in today's video, but also the level of contracts being signed between buyers and home builders is quite the opposite here. So pendings of existing houses are counted the same way as sales of new home construction based on data from the US Census Bureau. So the US Census Bureau defines a new home sale as a sales agreement signed between a buyer and a home builder. So this is really acting more like a pending home sale. So sales of new houses compared to pending home sales of existing houses in the same month is more or less measured the same way based on purchase contracts being signed. Number two, in September, pendings fell 11% year over year for existing houses, and compare that to a 34% year over year increase for new home sales. So sales of new home construction are doing very, very well right now versus contracts being signed of the existing houses are falling greatly. So therefore, we have two entirely different housing markets here. In the resale market, we have a low amount of home sales and inventory levels at historically low levels as well. Compared to new home construction, sales are higher now compared to pre-COVID levels based on the seasonally adjusted annualized rate for September. And also we have a high level of the amount of houses or new houses actually for sale. On top of that, builders are also benefiting from the anemic supply of existing houses as well. So to summarize this report from the National Association of Realtors, pendings did see a small increase compared to the previous month, but the current reading is still very, very close to an all-time record low. Therefore, because contracts signed leads to closed home sales in the next 1 to 2 months, we will likely see a very low amount of closed home sales for the remainder of the year. The pace of closed home sales based on the seasonally adjusted annualized rate according to NAR in September was at 3.9 million, which was already a 13-year low, the lowest reading since October of 2010. October's numbers will be released, by the way, in mid-November regarding closed home sales and also the pace of closed home sales from NAR. One more report I want to share with you guys, which is very much a forward-looking indicator of our housing market here, is this right here, a weekly update or report I share with you guys on the channel here. This was actually just reported today, which is November 1st. Can't believe it's November. Anyways, according to the MBA, applications for mortgages, which is refis plus purchases, decreased by 2.1% compared to 1 week ago. This is for the week ended October 27th this year. So let's talk about refis first. So the refi index decreased by 4% from last week, and it's also down by 12% from 1 year ago. What I'm more focused on is the seasonally adjusted purchase index, because that decreased by 1% this last week compared to the previous week. It's also down by 22% from 1 year ago. According to Joe Kahn, who's their deputy chief economist at the MBA, he said applications decreased for the third straight week. That's based on applications for refis plus purchases, as mortgage rates remain elevated, with rates around 30 basis points higher than they were 1 month ago. The 30-year fixed rate dropped slightly to 7.86% last week, but of course it remained very close to a 23-year high. He also says the average rate has also been above 7% ever since August this year as well. Now, here's something that really caught my attention as well, is that applications are now at the lowest reading since 1995. I believe the lowest reading since February of 1995. And of course, refi applications are also down greatly as well. What I'm really scratching my head regarding this is that refi activity is at 31.2%. So this means of all the applications, which is refis plus purchases, 3 out of every 10 applications for a home loan is still people doing a refi, which just blows my mind, given the fact that rates have increased so much, right? And we're right around 8% right now. Now, here's something that really caught my attention as well, which I have been important to you guys as well, is that the amount of people looking to get an adjustable rate mortgage has also been increasing as well. It says here, as higher rates continue to impact affordability and purchase power, ARMs or adjustable rate mortgages, those loans increased almost 10% last week and continue to gain share, growing to 10.7% of all applications. So 1 of every 10 applications right now for a home loan is for adjustable rate mortgage. The reason for that is this right here. The average rate for a 30-year fix last week, again, for balances less than $726,200, which is not a jumbo loan, a low balance loan, 7.86%. For a 5/1 ARM that is fixed for 5 years, then it becomes variable thereafter and adjusts every year based on current rates, was at 6.77%. So because that rate is so much lower than a 30-year fix, people are moving to an adjustable rate mortgage, which in my opinion is very risky because you're banking on the fact that you can refi or sell your house before your rate becomes variable. Or I should say, before you run the risk of getting a rate that could potentially be higher than the rate you have today. So in my opinion, very risky. But what do you guys think? Please leave me a comment below. Sorry, I'm not feeling myself. I am still feeling very tired for having COVID last week. Anyways, I hope you guys have an awesome day. We'll see you on the next video. I appreciate you. Like and subscribe, and we'll see you on the next video.